Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves. Bringing you the market insights that matter, delivered right after the closing bell. Please note this is an AI-generated podcast and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. Okay, so today, October 27th, 2025. Wow, it felt like a decisive shift, didn't it?
Absolutely, a real risk-on day across the board.
Right. So our mission today, for you listening, is really to get under the hood of this thing, understand the speed, the breadth of this rally, and then figure out the risks. Because there's a lot packed into this week ahead. Is this record run solid, or is it maybe a bit fragile?
Well, the first thing that jumps out is just how widespread the optimism was. You had all three main indices, S&P 500, NASDAQ, Dow hitting record highs at the close.
Record highs across the board.
Yep. The S&P 500 specifically was up about 1.2%. It closed well above that 6,800 level, around 6,875.
Psychologically important, that 6,800 mark.
Definitely. And the NASDAQ, no surprise, given the drivers, led the pack, up nearly 2%. The Dow added about 0.7% too. It really felt like unanimity.
Okay, so let's get into that driver. A move this big needs fuel. And the consensus seems to be it was the U.S.-China trade deal framework, the one reached over the weekend in Malaysia.
That's exactly it. It's all about removing uncertainty, or at least the biggest uncertainties. The market loves de-escalation.
So what specific parts of that framework really lit the fire?
I think two main things. First, the U.S. holding off on those threatened 100% tariffs. Hearing Trump's threat is now effectively off the table. That's huge.
A massive weight lifted.
Right. And second, China signaling they'll delay their potential rare earth export controls.
Yeah.
That's, critical for tech supply chains globally. Huge relief there.
Okay, so the threats recede. But was there any immediate, tangible evidence this wasn't just talk? Something concrete?
Soybeans. That was a proof point.
Ah, okay.
China committed to substantial purchases of U.S. soybeans, and you saw it instantly in the markets. Soybeans jumped, almost 1.5% to over $10.50 a bushel.
So real economic action, not just diplomatic language.
Exactly. It showed the framework had teeth right away.
And this wasn't just a handful of the usual tech giants pulling everything up, right? You mentioned the breadth earlier.
Yeah, that's key. This rally had legs. On the NYSE, advancers beat decliners by more than 2-to-1. Same story on the NASDAQ.
So broad participation, that signals conviction, doesn't it?
It really does. It suggests a lot of different players looked at the trade news and thought, okay, it's time to get back in, not just chasing the mega caps.
Makes sense. And sector-wise, tech obviously benefited from the trade relief.
Oh, absolutely. Technology-led. XLK, the sector ETF, was up about 1.6%. And within tech, semiconductors like AMD, NVIDIA, they were strong. Makes sense, right? Fewer tariff worries, fewer supply chain fears for chip makers.
But wasn't there one sector that completely missed the party, kind of sat it out?
Yeah, energy. The energy select sector, SPDR, XLE, actually fell, tumbled about 1%.
On a day like today, that's interesting. Why?
Well, it really highlights how fundamental issues can sometimes override broad sentiment. Even with all of the trade optimism, the energy sector is still grappling with these persistent worries about global oversupply. Crude prices were kind of mixed, but the sector itself couldn't shake those bigger concerns.
So even on a massive risk-on day, a fundamental headwind like oversupply can still hold a sector back. That tells you something.
Precisely. It shows that sentiment isn't everything. Those structural issues matter. It's a good reminder for you to keep track of those underlying fundamentals.
And zooming in on individual stocks, we saw some moves tied to specific news, too, reflecting that positive sentiment.
Yeah, Robinhood jumped over 5%, got some analyst upgrades. And Keurig Dr. Pepper, KDP, also up about 5% after they raised their full-year outlook. So good news, definitely got rewarded today.
Okay, so equities are soaring on trade optimism. But the flip side of that coin was maybe even more dramatic. What happened with safe havens? Gold? Silver?
Oh, it was brutal. A complete reversal, like someone flipped a switch.
How bad was it?
Well, gold plunged nearly 3%. It actually slipped just below that $4,000 level. And silver got hit even harder, down over 4.5%.
Oh. And gold was near all-time highs just a few days ago, right? Around $4,400.
Exactly. It was, $4,398 just last week. So this continues what people are calling its worst rout in, a decade.
So the mechanism is straightforward. Trade deal progress equals less need for safety.
Textbook geopolitical risk premium compression. As soon as the U.S. and China look like they're finding common ground, that need for a crisis hedge just vanishes. People dump the safe stuff and pile into riskier assets. The speed of it today really underscored the market's belief in this trade framework.
And what's weird here is the dollar, right? Usually, a weaker dollar helps gold. But the dollar is still weak today, down marginally, extending that big year-to-date decline. Yet gold still tanked.
Yeah, that's a great point. Normally, that weak dollar should provide some support for commodities, for metals, but today, the trade optimism, that pure risk-on sentiment, it just completely steamrolled that correlation. The sell-off was all about unwinding those safety trades.
And did we see that risk appetite reflected elsewhere, like in crypto?
We did. Bitcoin actually strengthened, reclaiming the $115,000 level. It mirrored that broader move away from safety and towards assets perceived to have more growth potential. Capital was definitely on the move today.
Okay, let's pivot to the bond market, because all eyes are on the Fed this week. What did Treasuries tell us today about expectations for the FOMC meeting?
You know, it was remarkably stable. The 10-year yield barely budged, ended pretty much flat around 3.99%.
So quiet. What does that signify?
It basically means the upcoming rate decision itself isn't the focus. A 25 basis point cut, taking the target range down to 3.75% to 4.00%, is seen as a lock. It's fully priced in. Virtually certain.
Okay, so the cut itself is old news, baked in. What are market participants watching for then?
It's all about Fed Chair Powell's press conference on Wednesday afternoon. They're hanging on his every word for forward guidance.
What is specifically?
What happens in December? Are more cuts coming? And critically, how does the Fed see the economy? Are they more worried about the labor market softening or about inflation, which, is still running at 3% year over year, still above their target? That's the balancing act they're watching.
And that rate outlook has real-world implications, like for housing.
For sure. With the bond market relatively calm ahead of the Fed, borrowing costs are a bit more favorable. The average 30-year fixed mortgage rate is down around 6.09%. That's the lowest in over a year, which definitely provides some support for the housing market.
Okay, so let's pull this all together. Record highs. Massive optimism fueled by a trade framework. A Fed cut that's basically a done deal. But we're heading into this incredibly condensed period, like 72 hours, packed with huge potential market-moving events, this feels like. Priced for perfection, maybe?
That is exactly the phrase for it. The market is celebrating the idea of trade peace and the certainty of this week's Fed cut. But if anything at all, deviates from that perfect script, things could get volatile fast.
Oh, so what are the big risks concentrated in these next few days?
Okay, number one, the FOMC decision on Wednesday. Yes, the cut is certain, but Powell's guidance, if it's more hawkish than expected or signals a pause, that's a risk.
Right. Disappointment is possible there. What else?
Number two, big tech earnings. It's a blitz. Wednesday after the close, you've got Meta, Microsoft, Alphabet, then Apple and Amazon on Thursday.
And expectations are sky high, aren't they?
Ridiculously high. So far this season, something like 86% of companies have beaten estimates. So for these giants, just meeting expectations might not be enough. They really need to impress.
And the third big one, the trade deal itself. The whole reason for today's rally.
Exactly. The Trump-Xi summit on Thursday. This framework needs to become a finalized deal. And remember, the really tough issues, tech transfer, chip access, those are still contentious. Any sign of trouble there, any hint the deal might stall, that could unravel today's gains very quickly.
And are there any technical signs suggesting the market might be a bit too relaxed about all this, like the VIX?
Yeah, the VIX, the fear gauge, fell again today, down over 5% to around 16.37.
So complacency creeping in.
You could read it that way. I mean, think about it. You've got the Fed, a wave of mega-cap tech earnings, and a high-stakes trade summit all crammed into basically 3 days. And the VIX is suggesting the market is insuring against all that potential turbulence for, well, pennies on the dollar. It does feel like maybe folks are underpricing the event risk here.
And stepping back, context is important too. The S&P is up.
Yeah.
What did you say? Over 80% since the lows in late 2022.
Yeah, an incredible 83.8% gain since that October 2022 low. That kind of rapid run-up inherently makes the market more sensitive to bad news. When you're priced for perfection, any small disappointment can feel much larger. So summing it up, today was definitely a powerful, decisive risk-on session. Record highs, fueled by hopes of trade peace. But that collective confidence, reflected in that low VIX reading, it's about to get seriously stress-tested by these three major events hitting almost simultaneously.
Okay, here's something to think about as we head into this critical period. We know the government shutdown is delaying some economic data, right? Making it harder to get a clear picture, potentially even for the Fed, regarding things like the labor market. So here's the question for you. If these huge tech companies, the ones carrying so much weight, simply meet expectations this week, no big surprises, just meet the high bar, is that enough of a disappointment to burst this price for perfection bubble? Or do they absolutely need to deliver blowout numbers to keep this rally going? Something to chew on.
That's the multi-trillion-dollar question right now.
That's all for today's episode of A Daily Consolidation. For more daily market analysis, subscribe and we'll see you at the next close.